Picture this. It's a quiet Tuesday night. You've just finished scrolling through your banking app, every bill paid on time this month. No late fees, no surprises. You even skipped the takeout you wanted because you're trying to be smart. You open that credit score app. You know the one. Heart beating just a little faster and it hasn't budged. Or maybe it dropped 3 points for no reason you can see. And in that moment you feel it. That quiet little voice saying, I guess I'm just not responsible enough. I've sat in that exact chair. Most of us have. That number feels like a judgment on who you are as a person. Like it's grading your entire adult life. But what if I told you it's not? What if the whole system was never built to measure your responsibility at all? Stay with me, because here's what almost nobody talks about out loud. We've all been sold this story that your credit score is basically a report card for grown-ups. Pay your bills, live within your means, be responsible, and the number goes up. Simple, moral, fair. But that story is missing the main character, the banks. The credit score wasn't created by some wise committee of financial therapists trying to help you sleep better at night. It was created by a company called FICO back in the late 80s, and then handed to the banks to use. And their goal wasn't to reward good behavior for its own sake. Their goal was to predict one thing with scary accuracy: which customers would make them the most money, and which ones would cost them money. That's it. Think about it. If the score was really just about responsibility, why does paying the minimum on your credit card every month not destroy your score the way maxing it out does? Why doesn't your actual income or how stable your job is factor directly into the number? Why can two people both paying everything on time have wildly different scores? Because the system isn't grading your character. It's running a profit forecast, and once you see that, a lot of the shame and anxiety starts to loosen its grip. You're not failing some universal test of adulthood. You're just data in a machine that was built to keep the banks in the black. That doesn't make you powerless. It actually makes you clearer-headed than most people walking around with that number living rent-free in their head. Let's go behind the curtain for a minute. Not in a conspiracy way, but in a, let's look at the actual math way. FICO and the credit bureaus, Equifax, TransUnion, Experian, built their models on mountains of historical data from millions of borrowers. They ran the numbers. Who paid, who defaulted, who paid late but eventually caught up, who carried balances forever. They fed all that into statistical models that spit out a single 3-digit prediction. How likely is this person to cost the lender more than they're worth? Not, are they a good person? Not, do they have their life together? Just, will lending to them be profitable on average? And that prediction is built on 5 ingredients. Not because they're the 5 pillars of responsibility, but because they're the 5 things that statistically predict whether the bank will make or lose money. First, and this is the biggest slice at 35%, your payment history. Sounds moral, right? Do you pay on time? But here's the bank's real question. How likely are you to stop paying altogether? Because when someone defaults, the bank doesn't just lose the interest. They lose the principal, plus collection costs, plus the opportunity cost of that money sitting somewhere else earning. A single default can wipe out the profit from dozens of on-time customers. So the model watches every late payment like a hawk. Not to shame you, to forecast loss. Second, 30%. How much you owe relative to your available credit. Utilization. This one feels especially personal. You see that 70% utilization warning and think, I'm being irresponsible. But the bank is thinking, this person is closer to the edge. If life throws them a curveball, job loss, medical bill, car repair, they're more likely to miss payments or default on everything. High utilization predicts higher risk of loss. That's why it hurts your score. But notice something sneaky. Carrying a small balance and making minimum payments, that doesn't tank your score the same way. Why? Because that's exactly the behavior that generates steady interest revenue for the bank month after month. The system quietly rewards the kind of customer who keeps the profit machine running without quite tipping into default territory. Third, 15%, the length of your credit history. Longer history equals more data points equals more confidence in the prediction. A 20-year-old with perfect payments for 2 years is still riskier in the model's eyes than a 45-year-old with the same record for 15 years. Not because the younger person is less responsible, because the bank has less statistical proof they'll stay profitable over time. Fourth and fifth, new credit and credit mix, 10% each. Too many new accounts or hard inquiries in a short window. The model sees someone who might be desperate for cash, about to overextend. Again, risk of future loss. Having a mix of credit card, auto loan, mortgage. It shows you've handled different kinds of debt before. More data, more predictable profit. See the pattern? Every single factor is a proxy for one question the bank is asking behind the scenes. If we extend credit to this person, are we likely to collect more in interest and fees than we lose to defaults and collection headaches? That's why your actual salary or how long you've been at your job doesn't show up directly. Those things matter to you, but the score is built only on the data the banks can legally use to forecast their own bottom line. And here's where it gets really interesting. Once they have your score, banks don't just say yes or no. They use it for something called risk-based pricing. Low score? They'll still lend to you, but at a higher interest rate. High enough that the extra interest you pay compensates for the higher statistical chance you'll default. The goal, and this comes straight from how the system was designed, is to make every customer roughly equally profitable on average. The guy with an 820 score gets a 6% mortgage rate. The guy with a 620 gets 8.5%. Over 30 years on a $300,000 loan, that extra 2.5% is tens of thousands of dollars straight into the bank's pocket. That's not punishment. That's the profit model working exactly as intended. Landlords do the same thing. They're not reading your soul when they pull your score. They're thinking, statistically, this person is less likely to leave me chasing rent for 3 months and then force an eviction that costs me time and money. Same prediction tool, different industry. It's all one big risk adjustment machine. So here's the moment everything can shift for you. When you stop seeing your credit score as a verdict on your worth as a human being, and start seeing it as a very sophisticated profit prediction tool built by and for lenders. The emotional weight changes. The shame quiets down. The panic when it dips 3 points feels less like, I'm failing at life, and more like, the algorithm is just updating its forecast based on 1 month's data. You realize you're not in a morality play. You're in a business transaction. And once you see the game clearly, you can play it without letting it play you. That realization is quiet freedom, because suddenly, the score becomes a tool in your toolbox instead of a chain around your neck. You can use it to get better terms, lower rates, more options, while keeping your eyes on what actually matters: your cash flow, your peace, your family's security. The number stops defining how you feel about yourself at 2 a.m. So what does this look like in real life? Not some hustle culture checklist. Just calm, doable moves that respect how the system actually works. First, treat utilization like the risk signal it is. Keep your credit card balances under about 30% of your limits most of the time. The easiest way? Pay more than the minimum when you can. But don't beat yourself up if life gets tight 1 month. The model forgives a temporary spike more than chronic high balances. Second, let old accounts stay open. That length of history piece is powerful and quiet. Closing a card you've had for 12 years because you don't need it anymore can actually hurt the prediction the bank wants to see. Third, be thoughtful about new credit. 1 or 2 applications when you're shopping rates. Fine. 6 in 2 months because you're stressed and applying everywhere? The model reads that as risk. Fourth, and this is the one that actually protects your sanity, build the stuff the score can't see. An emergency fund. A budget that actually fits your life. Multiple income streams if possible. Because when life hits, those things keep you from becoming the high-risk data point the model fears. The score improves as a side effect, not the main goal. And here's a real example I've seen play out with friends. Sarah was 34, decent job, paid her bills. But her score was stuck in the mid-600s because of old medical debt and one maxed card from a tough year. She felt like a failure every time she thought about buying a house. Once she understood the score was just a profit forecast, she stopped spiraling. She negotiated the medical debt down, paid off that one card aggressively but kept the account open, and started putting every extra dollar into a high-yield savings account instead of obsessing over the number. 18 months later, her score had climbed into the 700s naturally. She got approved for a mortgage at a rate almost a full point lower than she would have before. That 1 point saved her roughly $25,000 over the life of the loan. But more importantly, she slept better the whole time because she no longer felt like the number was judging her soul. Look, none of this makes the system perfect. It's cold. It's statistical. It sometimes misses good people and rewards behaviors that keep you in the bank's profit column longer. But knowing the truth takes the sting out. You are not your credit score. You never were. That number is a tool banks built to run their business efficiently and profitably. You can use the same tool to get better deals, lower rates, more breathing room, but your real financial life, the peace of mind when the car breaks down, the freedom to say no to a job that's killing you, the ability to help your kid without panic, that's built on decisions the score will never see. So keep an eye on the number. Play the game just enough to get the advantages it offers, But don't let it rent space in your head for free. You're already doing the hardest part just by being here, thinking about this stuff. Small, consistent moves compound, not just in money, but in calm. And that calm? That's the real score that matters. Thanks for spending this time with me. If this eased even a little of the weight you've been carrying around that number, I'm really glad. Take care of yourself out there. Progress beats perfection every single time. I'll see you in the next one.